It's just everybody's coming to the year so bullish that if there are any disappointments, what's going to hold the market up?
Hi everyone, JJ here. Welcome. Well, today I'm going to react to a video by Joseph Carlson, who's looking at an interview with Steve Eisman. If you don't know who he is, he's the Big Short investor. He played by Steve Carell in that movie, The Big Short, if you've seen that. So the financial media does look to him in interviews for what he thinks about the market, and it's interesting to know. He's a very thoughtful investor. He gets quite a bit right. He does think that people are a little bit too bullish. So let's get into it, see what he says.
He believes the market has gone up too fast. He thinks that investors are getting a little bit too excited right now.
I mean, think of it this way. Let's say we were here a year ago. Most of your guests would have come in and said the earnings of the S&P are going to be down. The market's going to be down. The economy is going to go into a recession in about 15 seconds. And none of that happened. The recession that never was. And so the market climbed the wall of worry the whole year. So now here we are a year later, and everybody is, including me, has a pretty benign view of the economy. The only thing that bothers me is just that I don't think we're necessarily wrong on the economy. I think we're probably right. It's just everybody's coming to the year so bullish that if there are any disappointments, what's going to hold the market up. But I think long term I'm still very bullish, but near term I just worry that everybody's coming to the year, feeling too good.
I get Steve Eisman's point here that it was a big Santa rally at the end of last year, and a lot of economists were wrong about last year. I think something like 80% of economists said that there'll be a recession last year, thought it was going to be a recession. It didn't happen. The market, I think, is pricing in a soft landing, which really I'm not sure has ever happened before. It might have happened and people just forget about it. I get Eisman's point that the market is kind of priced as if there's going to be no recession. It will be a shock if any of the data comes in badly, but this is just predicting again. Anything can happen. We talked about the AI situation where that could boom throughout the year, could make the market boom even if economic conditions aren't so good. We'll just have to see. We just can't predict.
One thing I think is interesting to look at from time to time is the forward PE of the stock market, of the S&P 500 in particular. The Wall Street Journal gives you the weighted average forward PE of the S&P 500, and today's price, based on next year's expected earnings of the S&P 500, it trades at a 21.5 multiple. So SPY's trading at a 21.5 forward PE. Now last year, it was trading at an 18.5 multiple. So it's gone up in valuation quite a bit year over year, from an 18.5 to a 21. So based on the average historical valuation of the S&P 500 on its forward earnings, things are at the high end of the scale. They're a little bit higher than normal. Now, I'm not saying that it's an extreme bubble territory or anything like that, but the market's trading with a little bit more bullishness. Things are priced a bit higher, and it wouldn't surprise me if we continue to have a bit of a pullback. That shouldn't be something unexpected. So I agree with Steve Eisman's cautiousness or his nervousness about how bullish the market is. I haven't been doing a lot of buys recently. I've been waiting for a little bit of a pullback to see any type of weakness in the market.
Pullbacks are kind of normal in the stock market. A pullback of 10% at least in any given year is kind of standard, even more than that, especially after a big rally. For myself, I wouldn't be surprised if there's a pullback as well, but again, I still wouldn't be surprised if it goes on based on this AI rally for the rest of the year. We have people like Dan Ives who've said there'll be a roaring bull market in tech, which could happen. It could go either way.
He talks specifically about big tech and the Magnificent Seven. Should you stay invested or be invested in the Magnificent Seven even after their massive rally in 2023?
I still think, you have to have at least a significant percentage of your assets in the Magnificent Seven there.
That's a pretty incredible line from Steve Eisman. Even after the enormous outperformance in 2023 of the Magnificent Seven, he still suggests to investors that you still need significant exposure to the Magnificent Seven. His reasoning for this has remained the same for a long period of time. The Magnificent Seven, big tech, that's where commerce is happening. That's where the economy is happening and transactions. If you're trying to invest outside of that, you're going to have a very difficult time keeping up with the market. So even as a value investor, Steve Eisman still believes you need exposure to these big companies.
Now it's worth saying here, Joseph Carlson does invest in these big stocks, in stocks that are really big tech, giant tech. I'm more interested in smaller caps, but I do invest in tech. There are quite a few investors, so-called super investors, invested in these stocks too, the Magnificent Seven. Now, of course, Berkshire Hathaway, Warren Buffett is heavily invested in Apple. There's no signs of him selling, just because you could say it's a little bit on the expensive side, or it's run up certainly since they've bought it over multiple years. It's tripled, quadrupled since they bought it. They're known to hold for a very long time. I'm not sure how long that Eisman holds his stocks for. I don't know if he's long-term, looking for those long-term compounders, But if you were that kind of investor, of course, you'd still be holding those stocks if you're invested in them, as Joseph Carlson, I think, is probably for the long term. I'm looking for smaller stocks, much smaller, much longer runway for growth. I don't talk about my individual stocks on here. If you want to hear more about that, it's the Art of Value Patreon. I'll put a link in the description to that so you can find out more of what the stocks I own. It's not investment advice at all. It's just what I'm doing. Go and check that out if you want to, and I'll see you over there.
He highlights some other themes in his portfolio.
Talk to our investors about like infrastructure. 1.2 trillion is still going to get spent in the United States over the next 10 years. First time we've had a industrial policy in the United States of America, probably since anybody in this room's been alive. So that's a big theme.
He mentions infrastructure, and he's been beating this drum for a while. I think it's something unique to Steve Eisman. I don't see a lot of other people going into infrastructure or stressing that as an investment opportunity. When I think of infrastructure, I think of Berkshire, maybe Brookfield, Asset Management, BN. I think those companies are in the infrastructure territory, but I'm still not sure exactly what companies Steve's talking about when he mentions infrastructure.
Now, I've made previous videos about Steve Eisman, and one where he was talking about infrastructure, and I know he mentioned in that video, which I'll put a link in the description, that he was talking about grid infrastructure, the electricity grid. Now, for instance, this ETF here that I track, I do not own it. I want to stress that, and it's not investment advice. It's just an example of some grid infrastructure that he might be looking at or others might be looking at. This is a smart grid infrastructure, updating the grid to more of how it works like the internet eventually. It's not just a one-way old technology industrial grid, a grid that's different, smart grid technology. And we can see that over the last 5 years, it's up 145%, which is beating the S&P 500. We can see that dip in 2022 was around 30%, but it's picked up again. So it's done pretty well over the last few years. Now, if you're getting value out of this episode so far, I'd really appreciate it if you hit that like button to help the algorithm to spread it to more people, because that's what we want. Thanks. Steve Eisman was talking about the electricity companies in California and replacing a lot of the infrastructure. So I think he's thinking about these things. Now, this is kind of digital infrastructure, or turning more and more to that. And I do have some exposure to digital infrastructure. I only talk about individual stocks on my Patreon. So for $5 a month, you can find out some of the individual stocks that I own. You can even just join for 1 month if you want it, but it's not investment advice at all. I don't do that, of course. I'll put a link in the description if you want to check that out. Now, this is just for Patreon. This is the company I was talking about.
Moving on, he does mention banks, and he's always going to get asked about banks because he is the big short investor that made his name, his reputation, shorting the big banks. And so far, from what I recall, over the past year, Steve Eisman has said that banks are uninvestable. Let's go ahead and see if his opinion has changed in 2024.
It's always interesting to hear his position on banks. Obviously, the big short banks were heavily involved, and he did very well there. So let's see what he has to say.
Let's pick on one bank. I mean, and I have no position in this bank, and I have nothing against the company. So Bank of America is a very well-run bank. It's got a very good CEO. That doesn't mean they haven't made mistakes. They bought a hell of a lot of long-term bonds at the wrong point in the cycle. It's not a balance sheet problem. It's more of an earnings problem. So the earnings, if you look, are basically flattish for the last few years, up and down by just a little bit of percentage. So how are you going to make money in Bank of America? You're going to need really two things. You're going to need the Fed to cut rates, so that'll help people's perception of the balance sheet. And you need no recession, so benign credit. Now, could that happen? Sure.
What he outlines here, with all of these things needing to fall in place for Bank of America to grow their earnings at all, that really does not make up the qualities of an attractive investment. So I can see from his viewpoint why he's not invested in banks. I'm not invested in them either. I agree with him.
Of course, he's looking at big banks here. Bank of America, one of the biggest, the big banks, but there are also regional banks involved, which he didn't mention there. He has mentioned them in the past. But those two things he mentioned, the lowering of interest rates, the Fed has kind of signaled that they're prepared to do that if things go well. The market thinks, a lot of people think there's going to be a soft landing, a pretty benign economy, including Steve Eisman, as he says here. Joseph says that he doesn't own any banks here. He doesn't want to, doesn't see that that's a good thing. Now, I do own one bank as it happens, a regional bank. Again, it's in my Patreon, so I only talk about that over there. Just $5 a month if you want to find out more about the individual stocks, not investment advice at all, but again, link in the description if you want to know about that. Now, this is just for Patreon. This is the one bank that I own.
Now, the next thing that we get Steve's view on is interest rates this year. The market is pricing in this bullish stance of 3 interest rate cuts this year, and Steve Eisman does not agree with this.
I'm actually of the view, the market seems to think the Fed's going to cut rates at least 3 times this year. I, at this point, don't have that view. I think the Fed is still petrified of making the mistake that Volcker made in the early 80s, where he stopped raising rates and inflation got out of control again. So I'm not that bullish on the Fed cutting rates. And if that's correct, I think it's going to be hard to make money in the major money center banks. Now, that's not a company-specific call. That's a real macro-y call. It's hard to make a long-term investment case for the banks when you have to deal with so many macro factors like that.
Again, I agree 100% with them. I think it's very difficult to invest in companies on the basis of interest rates doing certain things in the future. But there's many investors out there that will bet on these macro factors. I'm not one of them.
Now, I agree with that too. As Eisman said, it's a macro call, and macro calls can be wrong and very difficult to make, but he's willing to say something about it. And as he said, he thinks the market's pricing in 3 interest rates cuts. That, well, could not happen, but anything can happen. Investing on macro calls is very hard, as I've said before. Only very few people can do that successfully over the long term. People like Stanley Druckenmiller, who hasn't had a down year in more than 3 decades. He's invested in Nvidia at the moment. This last interview, I don't know if he still is. He was saying about Nvidia that it can go on for 2 or 3 years like the dot-com bubble rather than just a short time. And at the time he was speaking, it had only been going for a year. But these macro calls and market calls are impossible to make really predictions.
Now, another big theme of 2023 was artificial intelligence. That was something that was headline news all across 2023. And we know that there's some big winners in AI, specifically NVIDIA. Well, we get to see Steve Eisman's view on how artificial intelligence will impact the earnings of companies in 2024.
Other than NVIDIA and maybe AMD and, maybe some Microsoft, I don't think you're going to see that much of an impact on earnings in tech yet. It's still going to be very story driven. Other than the very, very large tech companies, nobody really yet has a real AI story to tell. And the question is anybody going to emerge?
Now, this was a bit surprising. He's saying that other than big tech like NVIDIA and a few other big companies, you're probably not going to see that big of an impact of AI on companies' earnings in 2024. It's mostly going to be a narrative-driven thing. I think I agree with that for a lot of the stock market. There's many companies that really aren't going to benefit that much from AI. For example, I can list off Costco. How does Costco really benefit from AI? I don't think at all. And I think there's a lot of companies like Costco that they can try to, have customer service bots or something. But other than really small things, they're not going to make drastic changes. But that's a portion of the stock market. I think there's a huge portion that's going to benefit. Lots of software companies, Salesforce, Intuit, CrowdStrike, all these tech companies are integrating AI into everything they do. Now, they've been doing this for a while, but AI has advanced dramatically over the past year. So maybe overall, with the entire stock market, AI won't have that big of an impact on earnings. But I think with the segment of tech companies, software, any type of data company, a lot of the type of companies I like to invest in, AI has a disproportionately big impact on these companies. They are integrating it into everything they do. If you listen to the earnings calls on companies like Intuit, they are leveraging AI with almost everything they're doing with these companies. So I both agree and disagree a little bit here.
So there's quite a lot there. Eisman thinks that it's narrative-driven, story-driven, what's happening in AI, and that's true. There's been a run-up in AI, a mini bubble, if you will. Jeremy Grantham has called it a mini bubble as part of a bigger bubble that started deflating. Seth Klarman also said it was deflating, and then it's taken off again. We can question how long this is going to go on for. As I said, Stanley Druckenmiller thinks that it could go on for 2 or 3 years, not just 1 year, which it's really been just over a year at this point. But story can drive the market rather than earnings, and we'll have to see how it plays out. It's very early days with, say, Google and OpenAI and others that are jostling for position, jockeying for position in terms of the technology, and it's moving very fast. Joseph says here that companies like Costco, it's hard to see how they could. Amazon, of course, is one of those companies that could benefit from it in many different ways with all the algorithms they use in online buying. And Costco could get more into it. They probably will get more into online over time, so it could help there. But I see his point there that a lot of companies won't benefit. Now, if there's a boom, if it turns into a bubble situation with AI, a big bubble, where it could go on for a multi-year period. Some people are predicting that, like Dan Ives and others. In my last video where I was reacting to Jeremy, who had these analysts on, like Dan Ives, who was talking about this is the start of a bull market, really leading to a bubble in AI. That was a multi-year bubble. That could happen, but we can't predict that. It's fun to speculate, and it would mean that this year, say the NASDAQ and the S&P 500 would keep on going probably into record territory. It's almost there now. Those people are sort of saying that it's going to be a very strong year after a strong year last year, and it could continue on. Back in the 90s, the dot-com bubble had a string of years that did very well, especially in the NASDAQ, and then, of course, it collapsed and had a string of not very good years, and that could happen. And obviously people like Eisman aren't ready to predict that. I don't think Joseph thinks that's going to happen. Narrative can drive markets for quite a long time. Now the market is a voting machine. It can be that way for a long time in certain stocks or even the whole market, but eventually it's a weighing machine where it's more about earnings and fundamentals. So we'll have to see what happens in terms of AI.
In summary, he thinks that the market's a bit too excited right now. He's expecting a little bit of a pullback. He thinks that you should stay invested or at least have significant exposure to the Mag 7. Don't avoid these companies, it's too difficult. He also believes that Bank of America or any large bank is not a great investment right now. He thinks that interest rates are probably not going to be cut as aggressively as the market's expecting. And he thinks that AI will be more of a narrative-driven thing than actually having an impact on earnings in 2024. For the most part, I find myself agreeing with Steve Eisman.
Now, I do agree with Steve Eisman on quite a few points here too. As I've said, I wouldn't be prepared to predict anything, especially the macro points, and thinking about scenarios. What if this happened? What if that happened? If interest rates go lower, if they go higher, if we have a soft landing, if we have a hard landing in the macro. But really, if we're long-term investors, it doesn't really affect it too much. If we're in a stock, we're not just going to get out of it because of a macro thing that changes, unless that changes the thesis of the stock in particular. So again, I do talk about this quite a lot, that it's not possible to predict the stock market even with great investors like Steve Eisman. He has his opinion on what things could happen, and the market of course is forward looking, so it definitely is pricing in certain things. There could be a pullback. I would say that that's quite possible, a decent pullback after the big rally we've had, but then again, we just don't know. We have to be ready for kind of all situations in the market, not to react straight away, but have a long-term plan, in my opinion, and just keep on investing for the long term. Can't really invest long term based on any short term situation. Now, what do you think about what Steve Eisman and Joseph Carlson have said here? Do you think that people are being too bullish in the market at the moment? Do you think we're due for a decent pullback? Do you think there's kind of an AI bubble happening? It's kind of fun to speculate, although we can't predict. Let me know what your thoughts are, and what are you doing? Are you investing based on that or not? Now, if you're watching this on YouTube, I'm going to put a video here of a previous Steve Eisman video I made, his thoughts about the market and the macro last year. And here I'm going to put a video of what the YouTube algorithm thinks that you in particular should watch next. So go and see either one of those. And don't forget to check out the Patreon if you want more of my thoughts on particular stocks as well, what I'm interested in, what I'm researching. And thanks everyone for watching or listening, and I'll see you in the next one.